S&P Global flash PMI data giving us a bit of a mixed picture of business activity for the month. Inflationary pressure intensifying in the month, but employment rising to its highest reading since 2022. Growth moderated in services activity as well, and you can see manufacturing data coming in above estimates for the month, seeing signs of a bit of a recovery in that area, which has been under pressure. Joining us to discuss those headlines and more, we've got Chris Williamson, S&P Global's Market Intelligence Chief Business Economist. Chris, I thank you for being here. I want to get your take on this kind of mixed picture that we're seeing, and specifically what it tells us about the stickiness of inflation. What's your read?
Yeah, there is definitely a mixed picture, but most importantly in relation to current output and what companies are expecting. We've heard all about animal spirits and so forth, and that's clearly evident here. So in terms of current growth, yeah, we had a slowdown apparent in January compared to really strong growth late last year, and that was led by the domestic focused services economy. Manufacturing, though, has re-entered some growth territory. It's only modest, but for the first time since last summer, manufacturing's now moved into expansion. But what's most important is we've seen future output expectations, what companies expect their own output to be in a year's time, really surge higher in that manufacturing sector. So they're clearly expecting the modest growth we've seen in January to build momentum as we go through the year. Also elevated expectations in the services economy. It's down a little bit, but near 3-year highs. So future output expectations are very strong. Now, this has been matched by a revival of hiring. So hiring's up at the fastest rate for 2.5 years in January, as companies are looking to really expand capacity in line with this optimism. But there's a cost come to that, and that is that wage growth in particular and some higher fuel prices coming through, pushing up these price indices a bit. So something really to watch there.
So then, Chris, I'm curious just to get your reaction to the bond market's reaction then to this. Very much it seems to be shrugging it off when you take a look at the equities reaction. We're not seeing a huge move to one side or the other on the back of this report. What is that indicative to you just in terms of current market sentiment and maybe what this signals about what's next?
Yeah, well, although these inflation numbers are ticking higher, they are still broadly consistent with the Fed's 2% target. So it's something to watch as we go on. It's not ringing alarm bells yet. There's just a little bit of upward price momentum coming through there, which in some respects is a good thing because you want companies to have pricing power. So it's good for a profits indicator that the economy is continuing to grow and firms are doing this without having to discount. So there's a positive signal there, but it's just something to keep in mind. Let's keep watching these indices come through the years to whether if they continue to move up, and if you see some further labor market shortages in particular start to push those wage rates higher, then we could see some red flags. But at the moment, it's fairly benign.
And of course, we're seeing stocks hitting record highs on President Trump's first week in office. I want to get your take on something he said at the World Economic Forum this week.
The EU treats us very, very unfairly, very badly. I love the countries of Europe, but the process is a very cumbersome one. And they do treat the United States of America very, very unfairly.
Chris, of course, this comes in the context of a lack of clarity on what Trump's tariff positioning could look like under his administration. What does a potential U.S.-EU tit-for-tat on tariffs mean specifically for the U.S. exceptionalism trade that we've seen doing so well?
Well, without getting sort of bogged down in too much speculation around what it means, I think when you look at the business situation, there's not a lot of concern there at the moment. So the PMI that we've just had out for the US, we had an earlier one out in Europe, in fact showing manufacturing sentiment, notably in Germany, really starting to pick up. They are moving into 2025 thinking, hey, hang on, we've not had tariffs slapped on us yet. We've got some lower interest rates coming through in Europe. It's going to help drive growth. And I think companies are really looking at, let's see what the domestic drivers are doing here. And they're starting to look more positive in Europe at the moment. So downplaying some of those tariff concerns that have been really heightened late last year. Of course, we can only speculate what might be implemented. by the new US administration going forward. And clearly there's some noise here around what might take place. But at the moment, we can only work on the basis of what's actually been announced. And it's not a lot so far in relation to Europe.
Chris, just given the U.S. exceptionalism standpoint, just in terms of maybe where the U.S. economy stands relative to the rest of the world, there certainly has been this argument, we've heard it from a number of our guests this week, that this very much gives President Trump more room to negotiate and ultimately get what he wants. I'm curious, how is the rest of the world viewing that stance right now?
Well, I mean, I can't put words in their mouths, but what we can see by the data is that certainly that gap narrowed a bit in January. The rest of the world doesn't seem to be falling apart and panic about what to do about this. They're taking a more measured approach. We can see the business sentiment levels in the PMI data. They're holding up. They're low. They're weak. It's subdued growth in Europe. Japan, also some subdued readings there, but things are, again, they're holding up. So it's a case of seeing what President Trump actually enacts in terms of his tariffs and his other threats, and then take a measured approach to how to respond to those. But at the moment, as I say, the reaction, certainly from the business environment, has been one of not panicking, carry on as normal, and look to domestic markets, perhaps more than the US, as to where you can grow your business.
All right, Chris, thanks so much for your insight there. Have a great weekend.
Thank you.